Hi, I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, founding CEO at Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgren's Investor Insights. Join us as we dissect the biggest and most interesting news on economies, financial markets, and central banks globally. Welcome to the show. Hi, Peter. It's the final week of January. What have you been up to this week?
Oh yeah, January has simply sort of been flying away. Yeah? It's a very busy start of the year, and it's really good. We
Mm-hmm.
are having good conversations with investors, getting inflows into our funds also already so far this year. And then we are also initiating really strategic next steps in the company, reaching like minimum 2 years ahead. So truckloads of interesting things going on from daily business to strategic steps. So that's
Mm-hmm.
only good. What about you? What are you up to?
We like being busy, Peter, but over the past few days, we've been, of course, doing a lot of monitoring. And just from this morning, some bad news from the Philippines. Well, bad for us in historical terms because GDP numbers just came out and it was a very sad 3% growth in the fourth quarter.
Mm,
That is low by our standards, but yeah. So it's something
yeah.
to reflect on as far as how we're coping with keeping the economy growing here. But otherwise, of course,
Uh,
that's still relatively fast when you look at other parts of the world. So there's that. Some
yeah.
of that
Yeah.
insight will find its way to our next magazine, for sure.
Yeah, there are a few things to discuss and how we see it this year's GDP growth. Yeah, so that was for sure much lower
Bummer.
than what we're used to and actually what investors expect. Yeah.
Mm-hmm.
So yeah, if there could be some sunshine somewhere else, but
Well,
yeah.
briefly, Peter, let's look at what we have for today. It's a mix of sunshine and clouds so
Yeah.
far. First, we'll look at Indonesia. Some warning signs have been flashed regarding its stock market, and we'll look at
Mm,
whether these concerns are valid or not. And then we'll look at several Western economies striking new trade deals with
mm,
Asian partners. So we have
mm,
an India European Union deal very freshly signed just this
mm,
week, and also
mm,
we'll look at a relatively smaller but still good deal between Canada and China. Then
mm,
heading over to the West, let's look. We will look at the waning consumer confidence among Americans and maybe
mm,
dissect it further as to why, and also, of course, somewhere along the way, we'll talk about the very fresh Fed result from the two-day meeting
mm,
yesterday. And
yeah.
then we will also look at the persisting weakness of the US dollar,
Mm,
particularly against the Japanese yen, and whether it's really great, as Trump put it, we don't think so. And of course, we'll end with our weekly global outlook, Peter. So let me start with the red flags against the Indonesian stock market. MSCI, we all are very familiar with this index. So they have warned against corporate governance concerns regarding listed companies in Indonesia. And that has really triggered a sell off yesterday. Both the Jakarta Stock Exchange main index and the MSCI Indonesia index were down by 7.5% in reaction to the warning issued. It's quite damning if you look at it because MSCI said the Indonesian stocks lacked transparency in terms of ownership structure, and they even flagged possible insider trading or coordinated trading going on. So that's really
mm,
price manipulation. Of course, these are things that you do not want to hear about any
mm,
company, and especially for a whole index, countrywide index for that matter. There's even a concern that if they were given a deadline to address these concerns, and if it's not met, they would be downgraded to frontier market status. So that's like
mhm,
the lowest tier that MSCI covers. I think a few podcasts ago, we talked about how Vietnam is getting promoted, and then here
mhm,
comes Indonesia at with the threat of going lower and lower that ranking.
mhm, mhm,
So it's really an issue of corporate governance and therefore market trust, which is very fundamental in terms of being investment worthy or not
mhm.
investment
Yeah.
worthy. And of course, a country like Indonesia, it's an emerging market. It needs all the foreign capital that it can
Mm,
attract to quickly grow. And a setback like this is quite major. I think what's important here is that apparently in October, even their own finance minister already
mm,
flagged these ownership concerns, this corporate governance issues towards
mm,
Indonesian stocks. And apparently he said that he actually knows some of the people who do this questionable trades, keep it opaque just so they could make more out of
mm.
it. I guess it's manipulation in so many words. And
Yeah.
yeah, and you don't like hearing that for any asset that you are considering to invest in. And it's such a waste to not
Mm.
be able to trust a market as potentially huge as Indonesia right now.
Yeah, yeah, this is truly serious. And MSCI is basically one of the most powerful voices in the world
Mm-hmm.
when we are talking about allocation into different markets, because basically all asset managers use MSCI indices as the benchmark.
Yes.
And also a lot of funds they track, a lot of ETF funds they track simply these MSCI indices. And if MSCI is downgrading Indonesia from emerging market status,
Mm-hmm.
it would go out of one of as the most important emerging market indices
Right.
that you can be in, and then it ends up in a frontier status. But allocations to frontier countries is much lower. So this, if that step happens, it means an outright outflow of capital from the Indonesian stock market. So this is serious, and the Indonesian government should take it extremely serious. Now, it also signalizes we have discussed Indonesia now
Mm-hmm.
and then in our
Yes.
podcast, and we have been a bit concerned about some of the initiatives that have been taken, also actually also economically, but
Yes.
things like sovereign funds that are funded domestic and aim to purchase domestic assets, we simply don't like. And this we have criticized. And what is the difference between the sovereign domestic sovereign funds and the sovereign funds that we know from, let's say, oil producing countries that typically have a simply enormous cash surplus and wealth?
Mm-hmm.
They are purchasing assets in other countries. So they are building wells outside their own country. Domestic sovereign wealth funds are simply, it's a government instrument to manipulate the financial market. And it's the worst thing that can happen. Governments should stay away from that kind of things. They should leave their hands off the financial markets, but
Mm-hmm.
they should ensure very strong like governance. And this is what is missing here in Indonesia. And that is keeping up the strength of the financial markets. That is strict discipline, and
Mm-hmm.
this is the only thing we can encourage also Indonesia to do. But investors should look out for it. This is our sort of growing concern for the past 12 months about Indonesia is growing more right now. That is simply how to say it. Yeah. Anyway, so another cloud, so to say, but important and important issue, and extremely good to raise. Yeah.
Thankfully, Peter, we
Um,
don't
yeah.
see signs yet that this cloud is creeping all over the ASEAN
Mm,
region. It appears that the concerns about opaque governance structures, as far as publicly listed companies are concerned, are an Indonesian problem
mm,
only. It would be great if it stays that way, or even it gets resolved as quickly as possible, or else,
mm,
um, of course, there's that fear, although small, that it could be spilling over, that tension, that nervousness could uh be spreading over the neighboring countries or neighboring markets, but we don't see that to be the case right now.
Good. That's also important.
And
Okay.
actually,
Good.
Peter, a bit
Hmm?
of good news. So the sunshiny parts of Asia coming. Just very recently, the biggest trade deal to date for India, with the European Union. So that's free
Mhm.
trade access to all 27 members of the EU.
Mhm.
It's been signed and it covers duty free sales across the Atlantic. And yeah, it is a huge alternative, a very useful one. And now that India is facing a 50% tariff for shipments to the US, it couldn't come at a better time. So it's really a huge combination. So India and the EU combined is a 2 billion market, population wise, and both together they account for 20% of world GDP. So that is a very exciting development. And yeah, it also could help ease cost of living issues just a bit as far as the European Union member states are concerned. And it is for India a way forward to diversify trade, expand trade elsewhere, while it reduces its reliance on the US. And then heading over to China with a relatively smaller but still good impact of a deal with Canada. It's
Mhm.
not a sweeping free trade agreement, but it's reduced tariff and reduced trade barriers. For one, electric vehicles from China, they can send more EVs, China-made EVs across to Canada at much lower tariffs. And then in
Mhm.
turn, they can get more canola oil from Canada. So bit of a small thing there, but it's better to hear this kind of agreements rather than hear a bazooka of trade and tariff barriers from their neighbor, the U.S.
Sure.
And yeah, um, Trump is upset about it, which is that he's saying, "Oh, China will dump every other good on you. It will eat up the Canadian economy, and then they'll use that to smuggle stuff into the US." Well, that deal
Yeah.
does not cover any other good for that matter. And if anything, it's really showing how economies are able to move past protectionism in the US. We'll just play the game with someone else. We'll just trade with someone else, and there are a lot more to talk to, a lot more countries to talk to and to do business with, if they just come together. So this
Mm.
is pretty big as far as market share is concerned, excluding the US, of course. And yeah, so it really just goes to show that there is a way around Trump's tariffs. And it seems that the rest of the world has caught on and they're now talking among themselves. And now he's the outlier.
Yeah, but it is interesting steps, and of course, as the Indian EU free trade agreement is, we consider it as pretty positive for India, yeah, and should also support the Indian stock market further
Mm-hmm.
upwards, actually. So that is good. And concerning China, interesting is that today, as a UK Prime Minister, Starmer is also in
In
conversation
Beijing.
with China about free trade deal as well. It just shows that naturally, as what we also have been talking about since a year, nations will simply find other friends, and trade will find other ways, and that is simply away from US. What President Trump is actually causing is the world is changing faster than even expected from our side.
Mm-hmm.
So that's actually what happens. And so the world continues to exist and also to grow. It will be with less US and a lot of other countries that are just finding the new ways and new friends. That opens truckloads of opportunities for investors, but of course we need to be good in finding these opportunities, need to think away from the classical stock we have been invested in for maybe a decade. Um, I a bit surprisingly came across an absolute fine investment bank
Mm-hmm.
lately, just a month ago or so. Uh, they advocated, they believed so strong in the US as an institution that they recommended still only to be invested into US. That is what I call a bet. I think that is strategic, a very difficult bet. But this is why we have a market. Some they buy, some they sell, some they move, some they stay. And this is why it is ever fantastic and fascinating to be a part of the financial market. So but these are interesting signs, and the world is simply opening up in a very different way. So, and that's actually good. It's positive for the world. Absolute sunshine.
Actually, Peter, maybe to as an antithesis to the very upbeat view of that bank towards the US, it's not looking as good as far as American consumers are concerned. Um, there is a new report about consumer confidence done by the Conference Board concerning US respondents, and it has the optimism has hit its lowest since May 2014. So that's almost 12
Yeah,
years ago. And it's
yeah.
uh, more pessimistic, less optimistic, whichever way you see it, than during the pandemic. So if we
Yeah.
think for most countries, for most economies, that's really the rock bottom as far as um, sentiment is concerned, because of course people were stuck at home, people couldn't do anything, people were laid
Yeah.
off. But this is worse than that. So the reading is mostly um, showing that, yeah, life is harder.
Mhm.
Expectations aren't good as far as the next few months are concerned. The US is facing stubborn inflation. It ended 2025 at 2.6% average. So the target is 2. So it's really well above that. Job market is tighter. And then respondents were actually saying that apart from inflation, which of course was also a problem right after
Mhm.
the lockdowns of the COVID-19 pandemic. So that was a common thing. But now the different thing in the context is that there are more reasons to be nervous, and it's
Mhm.
geopolitical. So January saw the arrest of the Venezuelan president, so
Mhm.
that was an issue. It also saw the revived plan to get Greenland from Denmark. So that's
Mhm.
another issue, and it's ruffling feathers. And then, of course, Trump is still trying to threaten more tariffs against its major partners. Canada and EU were the targets, although not yet executed as of our recording time. And then there's also, of course, that continuing pressure or mounting pressure towards the Fed's independence. So I
Mhm.
think these are conditions that weren't present in during the pandemic years. So it's really
Mhm.
more and heightened uncertainty and volatility that's making people nervous, and that ultimately translates to weaker spending, and of course weaker spending is weaker growth as far as the US economy is concerned, because how can people spend when they don't have a job or they think they're at risk of losing their job? And yeah, you
Mhm.
don't really like that. You don't want that situation for the US. Even the Fed saw that. The Fed has paused its rate cut momentum from its meeting this week. And yeah, while they say that some conditions have improved a bit, it's not necessarily convincingly better as far as their wording is
Oh,
concerned.
yeah. But the survey is actually fascinating in one way, because it is a bit unusual that U.S. consumers are reacting so much on how to say it, foreign policy. As a,
Mm-hmm.
if U.S. are entering a war, like again long time ago against Iraq or these kind of things, then of course people are getting nervous, and that is fully understandable. But
Mm-hmm.
this is actually this nervousness and uncertainty is more created by noise from Washington D.C. as a to be very precise from the Oval Office. Yeah, and this is a bit this is the unusual part of it. Many U.S. households they are a bit squeezed and under pressure for cost of living. That is a ongoing story, but many are doing okay. as also as you referred to, Fed is saying, okay, things are actually improving here and there, but it's not a strong signal. But households are not so much under sort of under pressure that it should end up in this 12-year low reading.
Mm-hmm.
It is simply noise, and that's amazing that a U.S. president can make so much noise, then the consumers are completely hammered. But this is a situation. It also means that they can recover pretty fast if there should be a change in the noise level. But
If
that's
he calms
it's
down.
hard to imagine it. But of course, the consumer confidence survey is extremely important to follow and keep
Mm-hmm.
an eye on. But anyway, and that it actually leads a bit call for the U.S. dollar to drop 10% this year.
Yep.
And one should consider it is very unusual if we even go decades back in the currency market that we had depending a bit on the currency you compare to, but a 15% drop last year, yeah, in the US dollar. That's a lot. And
Yes.
that actually costs for many European investors. Yeah, it is a reason why the US stock investments ended up in almost a zero game, yeah, for people investing into
Investment.
US indices. Yeah. Following year, with another dollar weakness. That is not usual. That is not sort of that usual, and so it's to have the call as well is
A
yeah,
bet.
yeah, it's a bit sort of where we really have been considering and say, okay, what is the most likely? But it is actually a deep consideration, saying, okay, this is what we believe. And the reason is also, as mentioned from the start of the year, here in December, that international investors will be nervous about the US position, about the US also overall economic situation, in particular the fiscal budget. And all of a sudden that US will start, or the Trump will start to spend more money to try to rescue a midterm election and sort of all the troubles he is making for the domestic economy. So there'll be nervousness about the quality, the credit quality about US bonds. Despite Fed is a bit on hold right now, we still consider more rate cuts to come.
Mm-hmm.
And it is typical when rate cuts are there physically that it hurts the currency and all around. Yeah. So this is what is going on, and we have now seen a drop in the US dollar during January. Depending a bit on what you use again as a comparison, if it's a euro, it's a bit more than 2%, 2.1% since the start of the year.
Mm-hmm.
Last week, last Friday, that was very significant against the yen. We saw a steep drop in the dollar yen rate from 158.5 to 155. And it actually has continued this week. And today we are trading, right now, as we record this, we are trading 153.5.
Yes.
That is a 3.2% drop in dollar yen within less than a week. And we've seen the same move towards a stronger Swiss franc. Swiss franc has gained 3% during January against the US dollar. And this is very classical safe haven movement
Mm-hmm.
in Asia, despite all the discussion about the Japanese budget and what happens. Japanese yen is still seen as a safe haven destination. And of course, still the good old Swiss franc is just a safe haven for each and everybody. And it is now again so critical for Switzerland, Swiss corporations, that this is hurting their competitiveness. The Swiss Central Bank or National Bank has problems dealing with it because they are already at zero interest rates,
Mm-hmm.
and they don't want to go into the negative
Negative.
interest rate regime again. So they are troubled, and are trying to find a solution, and it's hard for them to intervene heavily in the currency market because they have an agreement with US about not doing so. This is interesting, and we expect this to continue. Of course, this is our call, but we should also see what has happened. There have been comments already, interesting comments in the last 48 hours. Trump he just mentioned in one sentence that he was not so concerned about the dropping dollar. This is poisonous for the currency market. It's on the wrong day. It simply hits the markets and creates big moves. And we have seen he's sort of almost number two, yeah, or number three in the hierarchy. The U.S. Treasury Secretary, or what we call the Finance Minister,
Mm-hmm.
Scott Bessent, out saying US and the US government is behind a strong dollar policy. It was just after Trump came out with that sort of, yeah, sort of comment on the side, yeah. And we have seen the first European voices now, also within the past 48 hours, sort of pointing at that the euro should not increase that much more against the US dollar. So we have sort of the first, a bit sort of what we call verbal intervention. But US dollar can easily continue higher, and we're confident with our 10% US dollar call. And this is important for investors, as we have had a very long period where the currency market has been very sort of stable or moving very slowly. Now we see, as we had last year, the US dollar move, but this year it is much more an indication of all kind of currencies moving, and that is equal to higher volatility in the currency market. It also means higher volatility in the performance when we're talking about return for investors. We look into the portfolio, it is another volatility engine that we will see this year. That has not really been the case for a long time. And depending on how investors look at it, we have some investors who say, wow, that's noise and we don't like it. And other investors say, okay, this is another opportunity. But it's a risk to consider more than we've been used to. That's
Mhm.
basically also the conclusion. And again, making the markets even more exciting. So yeah. So interesting times and interesting moves also on the currencies. Yeah. Mixed bag today, huh, Mel? So what is sort of the outlook? Do we have sunshine at all?
We still do, Peter. Particularly for Asia, for example, also mixed bag as far as Indonesia's story is concerned, but otherwise, there is growing attention, even more right now than before, towards Asia at the time when everyone's moving away from the US and moving away from the uncertainty and the volatility of Trump's language. It's not that great for them, but it is great for Asia. The clouds, there are a bit more clouds on the horizon, but there remains pockets of opportunities. You just have to look more closely which specific areas they are in. So, for example, for us, we still prefer emerging markets in this region, and we believe that there is a lot of opportunity in the rapid growth that we're seeing relative to the mature economies. And as far as areas like Europe, we do see still opportunity in privately held sectors and privately held businesses. So that's where we are, Peter.
We look at it on a very tactical, on even more strategical level. We don't change that often in our outlook or
Mm-hmm.
advice about how to position the portfolios. What we are talking about today are actually very important points, but it's not enough for us to change anything. And we actually see more upside than downside still, being more sunshine than clouds. We of course reckon that US is the biggest economy in the world. It means a lot. But so far we are still happy, and we see enough opportunities out there to also to stay overweighted with risk, so to say, in the portfolio. So that's how it is still.
Thank you, Peter, for sharing your insights with us. And of course, thank you to our listeners for tuning in.
Thank you to all everybody.
Thanks for tuning in. We'll be on the lookout for market developments worth watching. Catch the next episode of Sound Economies, Mel and Peter on the global financial markets, available on our website and on Spotify. Here at Longines Capital, we've spent over a decade building a strong track record with our full suite of services and high performing funds. Now we're setting our sights on something even bigger, an IPO in November 2027. It's been a long time coming, and we are ready for the journey. Join us in our next big step. Visit our website to learn more.